The entire crypto market is entering a challenging phase where prices are no longer just numbers going up and down, but are the result of a series of impacts from the macro to the micro level. From trust to infrastructure, everything is on a downward slide, and the scariest part is that no one knows where the bottom is, or if there even is a bottom. So what is really happening with crypto? Is it true that crypto will fall endlessly, and are there any opportunities for us at this current moment? All of this will be explained in today's video. Pi from us will bring you the most understandable view of the crypto market, and we will help you lose the least amount of money when participating in this volatile game. Now, let's get into the video. Pi from us monitors the market daily and clearly feels the current coldness is not just a slight correction, as some people still convince each other. One of the biggest reasons for crypto's strong volatility recently is macroeconomic monetary policy. This is something the crypto world used to ignore, thinking they were against the system, but in reality, they still can't escape it. The U.S. Federal Reserve, Fed, has not loosened interest rates as many hoped. On the contrary, they maintain a hawkish stance of keeping high interest rates to curb inflation. This has created enormous pressure on high-risk assets, and crypto is undoubtedly a high-risk asset. When interest rates rise, investors start to recalculate risks. They are no longer interested in volatile assets like Bitcoin or altcoins. Instead, they seek safer havens like U.S. government bonds or, as is the culture of Asian people, hoarding gold, an asset traditionally considered a bulwark during uncertain times. This is quite understandable. If you're an investment fund holding that much money, why risk gambling with the crypto market when you can earn 4 to 5% per year from U.S. government bonds without worrying about losing capital? And gold has been continuously hitting new highs in the last 1 or 2 years. Attractive profits are not enough. Preserving capital is what matters for survival. Besides, changes within the U.S. government are contributing to making the crypto market more volatile. The SEC has a new chairman. This creates a new breeze of hope that the crypto market will be able to breathe more comfortably, escaping the constraints of Gary Gensler's era. But indeed, things are never simple. A wider open door also inadvertently creates opportunities for scams, pump and dump schemes that prey on the greed and blindness of the crowd. A very clear example is the meme coin case of Donald Trump and his wife, which was launched with strong support from the MAGA community. This token skyrocketed and then plummeted by 90%. Some people lost all their assets by investing in this trash coin. The incident not only caused financial damage, but also blew away the trust of many investors, especially newcomers. Pi from us finds it quite heartbreaking to read the sharing of holders. "I invested because I thought this was the president's coin. Who knew it was a scam?" If even the president dumps on the whole world, what can be said about other coins? Not to mention geopolitical tensions also make the already fragile market even more unstable. The U.S. imposing new tariffs on imports from China not only rocked the stock market, but also spread to crypto like a chain reaction. In the eyes of many, Bitcoin was once considered digital gold, a safe haven during economic instability. But it seems that this belief is gradually fading. U.S.-China relations are also not very bright. Tensions are rising, technology companies are caught in the middle and being more tightly controlled. International capital flows are becoming more cautious, and crypto, being a borderless asset, is the most heavily affected. The market is caught between the tightening policies of the West and the cautiousness of Asia. There's nowhere to hide, and a defensive mentality is taking over. In addition to macroeconomic issues, internal security attacks within the industry also contribute significantly to the market losing its recovery momentum. The hack of the ByBit exchange, losing up to $1 billion to North Korean hackers, was a big shock. This is a fairly reputable exchange, considered one of the richest in the market and highly rated by the community for its reliability. But after this incident, even those who once trusted it began to doubt. If one of the most stable exchanges can be attacked, who can be safe? zkSync is no exception, losing $5 million. This is not a large amount compared to the total value locked of all DeFi, but what is scary is the increasingly sophisticated attack methods. It's not just about losing money, but losing faith in smart contracts and the risk management capabilities of DeFi. Many people are now choosing to move stablecoins to cold wallets and stay out of the market instead of continuing to buy or sell anything. Furthermore, another factor that cannot be ignored is the operating infrastructure. Recently, the world's largest stablecoin, along with major exchanges like Binance and KuCoin, were all affected by an AWS incident. The system disruption, making deposits and withdrawals impossible, caused chaos in the crypto community. Some panicked, some blamed, but ultimately trust was once again eroded. And most importantly, it's the investor's psychology. Anyone who has invested in coins launched in 2023 onwards knows this best. SNet, ALT, Pixel, etc. These coins are currently down 5x or even 10x from their peaks. These coins were overvalued at launch. Then the team and investment funds continuously dumped on retail investors. Especially layer 2s like StarkNet, zkSync, and Scroll have all dropped sharply and show no signs of bringing investors back to break even. This creates great pressure on ETH because these are all layer 2s built on Ethereum. Stablecoins are not being injected into the ecosystem, and DX transaction volumes have dropped sharply. Looking at on-chain indicators, everything shows that investors are indifferent, no longer interested in taking risks. Not only tokens, NFTs are not out of the game. All NFTs once valued at millions in dollars in the previous cycle are now worth less than $10,000. People are increasingly having a negative view of crypto. This indifference is the scariest thing, because a market can survive fear, but it cannot survive when trust is depleted. Pi from Us has witnessed many market crashes, but this time is different. There are no longer many lively debates on forums, no more frantic buy the dip waves because people have already bought too much. Instead, there is a prolonged silence, a very characteristic coldness that only those who have experienced a crypto winter can understand. In short, the market is being dragged down by many factors at once. Tightening macroeconomic policies, geopolitical instability, internal industry problems, and above all, crumbling investor sentiment. From a personal perspective, Pi from Us thinks this is not the time to FOMO in at the top or go all in. This is the time to observe, to restructure portfolios, and if investing, to be extremely selective. Crypto will not die, but it is entering a strong purification cycle. Those who still have faith should be patient, and those who are dreaming should wake up before it's too late. So, what about the prices of top coins now? Right at the beginning of 2025, Bitcoin had a slight decrease of 1.5%, dropping to the 83,700 region after a speech by Fed Chairman Jerome Powell. Once again, we clearly see the impact of traditional finance policies on the crypto market, something that many people previously mistakenly thought was unrelated. We are not surprised by the market's reaction. Just Powell saying that interest rates will remain high for a while longer is enough for the market to immediately slump. In a context where investors are extremely sensitive, even a little FUD from the Fed is enough to wipe out billions of dollars in market capitalization in a few hours. Ethereum is in a strange state of limbo. Its price over the past 3 years has made almost no major breakthroughs since the merge and the second upgrade. Expectations of ETH becoming the irreplaceable smart contract platform are gradually being eroded by the harsh reality. It's always being left behind by Solana or layer 2s like Arbitrum, Base, and zkSync. It's like a king trying to hold on to his golden throne, but his courtiers are starting to whisper about his successor. Meanwhile, altcoins are under heavy pressure. Solana, once a great hope during the recovery waves in early 2024, has now reversed and dropped sharply from a price range near $200, now hovering around $150, and seemingly hasn't found a stable equilibrium point. RXP, as usual, continues to disappoint with its characteristic sluggishness. There was a time when it seemed that the end of the SEC lawsuit would be the beginning of an uptrend, but it turned out to be just a short-term illusion. The entire crypto market is in a state of correction with an average decrease of about 4.4% across the entire market capitalization. These days, you will easily see the amount of stable coins on exchanges increasing.
While trading volume is gradually decreasing, people are not completely withdrawing from the market, but they are also not eager to buy coins. Going back a bit to a recent important milestone, one cannot fail to mention that Bitcoin once reached an all-time high of $100,000 in Q4 2024. That moment was quite special. I still remember how frenetic the atmosphere was on Twitter and Telegram communities at that time. Everyone thought that $100,000 was just a temporary stop before Bitcoin went even further. But reality proved otherwise. Immediately after that was a correction cycle that has lasted until now. One quite interesting thing is that altcoins no longer move with Bitcoin. Previously, when Bitcoin rose, altcoins would follow suit, creating an Altseason. But now it's different. The money flowing into altcoins no longer uses Bitcoin as the main indicator. Instead, it's stablecoins like USDT, USDC, and fiat trading pairs like USD and Euro. This shows that the market has developed more in terms of structure, but at the same time, it also means Bitcoin is no longer a significant driver for other coins. If predicting whether Bitcoin will rise or fall or stay in a certain range, truly no one knows. because just a few days ago, it was $80,000, and now it's $105,000. It's really very difficult to act during this time, and only someone truly daring and lucky can profit from this. Altcoins will continue to face difficulties if Bitcoin dominance, meaning Bitcoin's share of the total market capitalization, continues to rise. An increase in dominance means that money is taking refuge in Bitcoin instead of risking it with smaller coins. This is a common sign during uncertain periods. What's noteworthy is that the possibility of a short-term recovery does not lie entirely in technical factors or on-chain analysis. Everything depends on macro news. Good news, such as the SEC approving more spot Ethereum ETFs or the US Congress passing friendly crypto legislation, could reignite a wave of investment. Conversely, just one negative tweet from a powerful figure is enough to pull the entire market down. Okay, that was a bit too negative. Now let's talk about the positives. There are times when the market makes me feel very heavy. Falling prices, bad news piling up, a divided community, shaken faith. But when I sit back and look closely at the fundamental factors that are gradually taking shape, I see a different story. It's more positive, deeper, and much more long-term. Crypto isn't just about coin prices jumping around every day. It's a revolution in technology, in finance, in control over assets. And it's these silent changes happening behind the market curtain that are truly noteworthy. Recently, you may have seen less media mention of politics in crypto, but for those who follow closely, policy moves in the US are bringing a new breeze. Donald Trump, though controversial in many aspects, is the one who dares to say out loud what the crypto world has long awaited, making America the global crypto capital. That's not just a campaign promise, but a sign that blockchain is no longer a small playground pushed to the sidelines of the traditional financial system. It is gradually moving to the center of the chessboard. Along with that, legislative bills like FIT 21 and supportive moves from the Office of the Comptroller of the Currency allowing traditional banks to custody crypto are extremely big steps forward. About 2 to 3 years ago, a large bank publicly holding Bitcoin for customers was almost unthinkable. Now, it's a strategy to expand financial services and win back younger users who are gradually losing faith in old-fashioned banks. With these policies, the line between traditional finance and crypto is becoming increasingly blurred, and that's a great opportunity for crypto to shed its image as a risky investment channel and step into a new role, a real asset class in the investment portfolios of both individual and institutional investors. One of the other important pieces in the long-term picture is stablecoins. You may have heard a lot about USDT as the most popular stablecoin on the market, but behind this name is a very bold expansion strategy. Recently, Tether launched Alloy, a multi-chain fee platform aimed at serving global payment and consumption needs using stablecoins. This not only helps maintain its position, but also enhances the stability of the DeFi ecosystem, which desperately needs solid financial foundations to attract new capital flows. When stablecoins become more accessible and transparent, the entire market will become easier for mainstream users to understand, a prerequisite for crypto to truly enter daily life. However, there is a truth that cannot be ignored. Stablecoins currently account for 63% of all illicit transactions, according to a recent statistic. It's undeniably a dark side, but it also shows something very interesting. Stablecoins have extremely high liquidity and are widely used even in underground markets. If viewed from a technology development perspective, only when a tool becomes efficient and convenient will it be used so much. And if the strong applicability can be combined with a stricter legal framework, stablecoins can absolutely become the backbone of the online digital financial system. Another thing is that the real-world applications of blockchain are becoming increasingly clear, no longer the vague demos of a few years ago. One of the advancements that I highly appreciate is the use of blockchain in cross-border money transfers. Previously, international money transfers were both slow and expensive. But now, with protocols like RippleNet or Stellar, you can transfer thousands of dollars across borders in just a few seconds with almost zero fees. Processing time is less than 1 minute, and the cost is lower than domestic money transfer. If you've ever worked as an international freelancer or have relatives abroad, you'll understand the value of this convenience. Not just limited to currency, blockchain also opens a whole new door for traditional investment through asset tokenization. Imagine a luxurious apartment in New York being divided into thousands of tokens. A Korean person could buy 0.1 ownership of that apartment for just a few $100s. This was a game previously only accessible to large investment funds or the super rich. Now, it's in everyone's hands. Tokenization of government bonds, private stocks, and even works of art is making the definition of investment assets more diverse than ever before.
If we look a bit further, the data on the long-term growth of this industry can truly make anyone optimistic. According to forecast reports, the crypto market could reach a value of over $13.6 trillion by 2032, with an annual compound growth rate of 12.8%. Even if you are skeptical, this number shows one thing for sure. This industry is still developing, and its development speed is not slow at all. In a context where many technology industries are stagnating, crypto maintaining double-digit growth is a strong signal of its inherent potential. Another rather surprising statistic is that 28% of Americans currently own crypto in 2025, while it was 30% in 2023. This is the result of a filtering and maturation process of the user community. Before, when the market was hot, everyone rushed in without really understanding what they were buying. Now, those who remain are usually those who have knowledge, experience, and a strategy. A higher quality community will be a solid foundation for the market to go further in the future. So, what do we need to prepare for the upcoming cycle? If you've been in this market long enough, you'll understand that crypto has never been a peaceful land. It's attractive, it's vibrant, but along with it comes an extremely high level of risk, and not everyone is clear-headed enough to accept it. It doesn't feel like investing in traditional stocks where everything happens very slowly and is somewhat predictable. Crypto is not like that. Its sensitivity to news keeps this market constantly on edge. Just one negative share from people like Elon Musk or a vague report from the SEC, and the entire market can turn red. And that creates a paradox. More and more people are participating, but most of them have an extremely weak mentality. Just one sharp price drop and they are ready to sell off, even cut losses at the bottom, inadvertently creating terrible psychological vortexes that push prices down further. This repeats itself like a collective psychological cycle. So the first thing to prepare is a strong mentality and a cool head to go through all the market fluctuations. Besides that, legal regulations are a double-edged sword for this industry. On one hand, I fully support the need for crypto to be regulated to avoid abuse and create a transparent development environment. But on the other hand, I also see very clearly that many DeFi projects, especially young ones, are struggling with the pressure of regulatory compliance. In the US, the SEC is expanding its oversight to all decentralized platforms, treating them as securities exchanges. This could significantly slow down the pace of innovation because startups have to spend too much time and money to navigate the law or try to legitimize their models. Even many altcoins that previously operated well in a free environment are now facing the risk of being delisted from exchanges or losing liquidity due to not meeting new legal standards. Another increasingly serious threat is cybercrime, ransomware, phishing, DeFi attacks, rug pulls. All of these severely tarnish the industry's image. Every time a major hack occurs, like the Ronin network incident, or more recently, ByBit losing up to $1 billion, it's clear proof. After each such incident, user trust is eroded. In reality, blockchain technology itself is inherently secure and transparent, but humans are the fatal weak point in the system. When investors are lured by irrational profits, when development teams lack ethics, or simply when security is too poor, the consequence is always a chain of heavy losses that the entire market must bear. And what's more dangerous is the normalization of fraudulent behavior. I've seen projects that were blatantly rug pulled, but just a few weeks later they rebranded and continued to call for capital. The community is strangely short-sighted. Many people even admire scammers for their successful exits, seeing it as a joke, a zero-sum game, rather than a serious market. In fact, when I look at this phenomenon, I feel more worried than angry. Because if even the community hasn't truly matured, how can we expect the market to develop sustainably? But perhaps the biggest risk doesn't come from the outside, but from within the participants themselves. The market sentiment right now is very fragile. Everyone invests with the expectation of X2, X5 in just a few weeks, so even a small correction is enough to make them panic. I've seen a lot of FOMO at the peak, and then those same people spread FUD and sell at a loss right at the bottom. A simple truth is that crypto is not for the impatient, like everything else. But ironically, the majority of current investors are exactly those kinds of people. This psychological loop creates a negative cycle. Falling prices lead to FUD. FUD leads to panic selling, and panic selling leads to deeper price drops. Only those who are brave enough, have a clear strategy, and don't follow the crowd can survive and continue. The rest mostly just serve as liquidity for the wiser ones. All these factors, from price volatility and risk to cybercrime and market sentiment, create an extremely harsh investment environment. It's not a place for you to make a quick buck or seek stability. Crypto is where you have to learn to live with chaos, accept that you can be wrong, know when to wait, when to withdraw, and when to go all in. And that's a little update on the crypto market in recent months. Although it's difficult, there's no shortage of opportunities, and opportunities only come to those who truly have discipline and patience. Do you think you are a patient person? Please comment and share with Pi from us. See you in the next video.